Hello, good morning. I am here once again, as I promised. The last time I was presenting you with the last week's this week's endings intelligence summary update. So for business intelligence, today I released the weekend intelligence newsletter, and it is out there. People are those who browse and enjoy are browsing it for the weekend. And for those who like to listen and look out for the weekend intelligence brief, Saturday to Sunday, 18th to 19th July 2026. This is the video aspect of it. And let me go into it without wasting any more time. Three things happened this week that had nothing to do with each other on the surface and everything to do with each other underneath. A government changed hands, a war that everyone thought was cooling down heated back up, and a report landed showing that a single lender collapse in February has now quietly worked its way into 49 separate business failures. None of these started in a boardroom. All three end up on a boardroom desk. Anyway, that's what we are covering this weekend. Segment 1. Let's start in Westminster. Downing Street. Andy Burnham was confirmed as Labour leader on Friday, and he is sworn in as Prime Minister on Monday. That makes him the 7th Prime Minister this country has had in 10 years, which say that number out loud is not normal. It's not a rate of turnover with any real modern precedent. Here's why a business owner should care before Monday morning rather than after. The instinct is to treat a change of PM as a political pages story. Resist that instinct this time. Burnham won his parliamentary seat a month ago. He's been Prime Minister in waiting, not a tested minister with a national policy record. He's been Prime Minister in waiting. He's taking over an economy senior civil servants are reportedly telling him is in worse shape than the one his predecessor inherited. Inexperienced leader, compressed timetable, deteriorating starting position. That combination tends to produce faster, less predictable policy movement than a normal handover because there is less institutional memory inside government to slow things down. Watch fiscal policy specifically because the early signals are already contradicting each other. The IMF has publicly told the incoming government to be selective about new spending. The CBI has separately warned Burnham against the CBI has separately warned Burnham against a repeat of last year's prolonged uncertainty over tax and spending, arguing that a long season of speculation is itself corrosive to business confidence. Regardless of what's eventually decided, so business owners are being told from two directions that clarity matters more than which direction things move. If you spend the next month betting on either outcome, more spending or more restraint, you are taking a bet neither the IMF nor the CBI is telling you to take. There is a second angle worth naming: Burnham's own instinct toward bringing more of the economy under public control and devolving power away from Westminster. Nothing here is a prediction of specific legislation, but any medium enterprise with exposure to energy, water, rail adjacent services, or transport infrastructure should treat the coming months as a period where long-term contract assumption in those sectors deserve a fresh look rather than an assumption of continuity. Three practical impacts. First, financial planning. Wealth managers are already fielding client questions about tax changes to inheritance planning, capital gains, and business asset reliefs. If your firm advises on these, candor about uncertainty bears false reassurance in either direction. Second, public sector clients and suppliers expect procurement priorities to shift as new ministers settle into departments, build flexibility into contract renewal timelines rather than assuming continuity. Third, and most immediately, staff and stakeholder communication. A brief, honest note from leadership acknowledging the transition is worth more right now than silence, which tends to read as either indifference or concealment. Segment 2. The second story, we are going to the sphere of oil. We are talking about energy here. Brent crude climbed from the high 70s to the mid 80s dollars a barrel over the course of the week, a weekly gain north of 10%, driven by a fresh round of military exchanges between the United States and Iran. That's again raised the prospect of disruption to shipping through the Strait of Hormuz. Roughly a fifth of the world's seaborne oil passes through that waterway. We are not going to get into the military situation itself. That's outside the scope of this brief and outside anything a medium enterprise can control. What matters is how it turns into cost, and there are two channels. Direct energy cost: any firm with a delivery fleet, energy intensive premises, or a freight dependent supply chain should expect renewed volatility and should treat fixed price energy contracts coming up for renewal next quarter as more urgent to lock in now rather than wait. And shipping and insurance cost: firms importing through the wider Gulf region or relying on suppliers who do should ask their logistics providers directly this week whether routing has changed and whether war risk insurance premiums have moved. These costs tend to show up in supplier invoices with a lag of several weeks, which is exactly why the businesses least prepared for a squeeze are the ones assuming this quarter's costs are a reliable guide to the next one. There is a third, less obvious channel: the interaction with domestic inflation. UK inflation has already been running above the 2% target, and a sustained rise in energy costs adds upward pressure right as the Bank of England's Monetary Policy Committee weighs its next move. Decision, its decision due the 30th of July. We are not forecasting that decision, but if you had been planning around gradually easing borrowing costs for the second half of the year, treat that assumption as considerably less certain than it looked a fortnight ago, and stressed near-term borrowing plans against rates staying higher for longer. Historically, shocks like this one don't fully unwind and don't stay permanent either. Analysts expect prices to settle somewhat above pre-escalation levels, even if the immediate crisis eases, because insurers and shippers are slower to relax elevated risk premiums than the underlying situation is to change. The sensible middle path treat roughly half of the recent increase as a reasonable planning assumption for the rest of the year and revisit monthly. None of this requires panic. It means a short conversation this week, not next month, with whoever owns your energy contracts and logistics relationships. Let's go to the next. The Kroll Contagion Report. Third story, and arguably the one your business is least prepared to see coming. Kroll published data this week showing 49 finance firms entered administration in the first half of 2026. A 63% increase on the same period last year. Nearly half of those 49 failures trace back directly or through a chain of intermediary relationships to a single collapse. Market Financial Solutions, the Mayfair-based bridging and buy-to-let lender that entered administration in February amid allegations its founder misappropriated funds in excess of £1 billion through a network of connected borrower entities. Here's why this matters specifically to a 50 to 200 person firm. You typically have good visibility into your direct counterparties, the clients you invoice, the suppliers you pay, the lenders you borrow from. You typically have much weaker visibility into the counterparties one or two steps removed, the referral partner whose own funding depends on a lender you have never dealt with directly. The Kroll data proves in concrete numbers what risk professionals have warned about in the abstract for years. A single sufficiently large fraud doesn't stay contained to where it originated, and the businesses most exposed to the fallout are often the ones with the least direct knowledge the exposure existed. 3 questions to ask over the coming weeks. Not an exhaustive audit that's neither realistic nor proportionate for a firm this size. One, does any material part of our revenue depend on referral or introducer relationships? And do we actually know who funds those introducers? Or have we just assumed they are stable because they've always paid on time? 2, do we hold client money deposits or undrawn facilities with any lender or platform whose funding model we haven't examined in the past 12 months? 3, if a key introducer lender or platform partner failed with limited notice, how many weeks of cash runway would we have before it became a genuine operational problem? And is that answer one leadership has actually tested rather than assumed? There is a governance angle too. The FCA has opened a formal enforcement investigation into the collapsed lenders anti-money laundering compliance. And the Financial Reporting Council has separately opened investigations into audit-related matters connected to the same group. If your firm has its own AML obligations, this is a useful low-cost moment to revisit how rigorously your onboarding and ongoing due diligence would catch a counterparty whose public presentation gave little external indication of what had accumulated internally. The thread. Step back for a second, because these three stories aren't obviously connected on the surface. Look again, and they are. In each case, a system businesses had quietly assumed was stable, a political leadership that changes rarely, an energy market that had settled after an earlier shock, a lending sector that had grown steadily for years, turned out to be considerably less stable than assumed, and the change arrived faster than most planning cycles are built to absorb. None of these three developments was in truth unforeseeable. Commentators had signaled the leadership change for months. Energy analysts had warned the ceasefire was fragile. Risk professionals had raised concerns about the specialist lending sector for years. What connects the three is that businesses treated them as a background conditions rather than active risks worth a standing line of monitoring. 3 decisions before Monday. 1. Hold a short conversation with whoever is closest to public sector contracts, financial planning, or government-facing relationships, confirming no one's assuming policy continuity from the ongoing government. 2. Contact whoever manages your energy contracts and logistics relationships and ask 2 direct questions. Are any fixed rate energy or fuel contracts due for renewal next quarter? And has any Gulf-dependent supplier signaled a cost or routing change? 3. Identify in writing which of your revenue streams or funding relationships depend on an introducer, referral partner, or lending platform, whose financial stability you haven't examined in the past year, and task someone with actually finding out. That's the brief for this weekend. The next AI breach report returns Wednesday with fresh incident intelligence. We'll be back next weekend, subject to the Bank of England's rate decision on the 30th, dominating the following edition. Until then, this has been the Weekend Intelligence Brief from Frederick Cybersecurity, protecting medium enterprises. Stay safe